Lots of aged and now fresh-eyed onlookers of the global gold market have been asking themselves this week, what is really going on with gold? Well, don't look to our fiat financialized Western media for many answers. Often, there you'll only find gold illiteracy and even flat-out lies printed in black and white for anyone with a calculator and a financial history book longer than a week to easily disprove. Gold over the last 100 years, even with fixed price riggings covering more than half that time span, have averaged near 5% gains since 1924 and nearly 8% annual gains since 1970. Each and every week on this SD Bullion YouTube channel, we try and bring you real-time updates of what we think is going on in the overall global bullion markets. This week will be no different. Here we'll try and give you both a short, medium, and longer-term view of where we think we are in this secular bullion bull cycle, and most importantly, where we believe we're trending to. Gold in fiat US dollar terms made a run at $2,200 an ounce intraday today to end this week's trading. Today is the same day massive US job revisions pointed out the underlying US economy is worse than what we've been collectively lied to believe. Yes, gold is likely sniffing out coming rate cuts faster than the market is flat-footed to believe, but we're going deeper and longer term than that vanishing pig lipstick job revision data. Fiat US dollar worshippers better note this is all currently happening on a relative fiat US dollar strength regime. While we're adding an additional $1 trillion US debt every 100 days or so, what happens in the coming years and perhaps decades of relative fiat US dollar weakness? I see last week's video of our coverage of massive Q1 2024 gold buying in China. It's gotten a lot of aggregation this week. Often such accounts are ready to sell you some type of hole in the ground with a miner on top. And for a while now, it's not been the time to be buying stories about holes in the ground leverage. Risk perhaps only what you can afford to lose long-term in miners and or ETFs. This remains a time to return your capital directly to yourself by simply owning prudent bullion positions outright. The central banks on net have been admittedly buying bullion in record size these last 2 years. Aside from occasionally nationalizing their own gold miners, instead of buying unsecured ETFs, I'd argue on net, government central banks have been raiding major unsecured ETFs for what bullion they can still grab on the cheap. This week, many Western financial pundits have been pointing out the ongoing obvious point that the spot gold price has diverged from net unsecured ETF selling in the West over the last few years. Well, since March 2020 on this channel, I've been pointing out raiding of ETFs is how COMEX and London have tried to remain relevant in ongoing gold price discovery power over the last 3 to 4 years. Last month, February 2024, China again added to its official gold reserves. That's the 16th month in a row. Russia and China have been lockstep, adding additions to their official gold reserves for decades now. This chart is not coincidence. But not merely in the East. Western investors in the EU, for instance, from large gold bullion buying nations like Poland and its citizens, increasingly the youth, as well as big private gold buying markets like Germany, all simultaneously are increasingly believing in gold's future potential as an investment class as well. And while in the second half of this week's SD Bullion Market Update, we'll get further into the weeds on where this current move in gold and then silver might run to, the building era of buy the dip, positive self-reinforcing gold price number go up seems not very far away from now. Turning again to the quaking U.S. banking system, the failing stock price of New York Community Bank was rescued this week with a $1 billion injection headed by former U.S. Treasury Secretary Steve Mnuchin. Bank analyst Christopher Whalen suggests he adds a zero to that bailout. At a minimum, the real estate portfolio of the bank is likely to take a negative 25% markdown at some point in the coming future. Here's Mr. Whalen on that point.
I think that $1 billion from Steve Mnuchin is not enough. I think they should create a bad bank.
Yeah, Chris, help us there.
You need 10. We need 10, Tom.
Yeah, well, just, we don't want numbers on a Thursday, but, I looked at, what was it, $1 billion? I said, that's like chump change. I mean,
in this context, yes, you have a $40 billion, more or less, multifamily book. What's a reasonable haircut on that, Tom?
Yeah.
Okay. 25 cents to start.
Yeah.
And we work back from that.
Turning now to Fiat Fed head Jerome Powell, at the very least, he's publicly admitting more U.S. bank failures are coming.
Can you discuss the compound risks identified in commercial real estate lending, particularly at banks with large CRE concentrations and high fractions of uninsured deposits?
Sure. Let me see. I think
there are just very, very few transactions in commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have the kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings. Not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And, this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first order issue for any of the very large banks. It's more, smaller and medium sized banks that have these issues. We're working with them. We're getting through it. I think it's manageable is the word I would use, but it's a very active thing for us and the other regulators, and it will be for some time.
As you're talking with these small and medium-sized banks, because we know there's always could be a contagion, which we've seen in the past, do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and prevent that from happening?
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank by bank basis and overall.
Okay.
And so far we've been able to do that.
Thank you.
And it looks like major commercial bank market makers and U.S. Treasuries are now trying to change their reporting rules, now that apparently financiers can't keep grifting outsized gains off the building U.S. bond bear market. While one of the largest financial firm heads admits that refinancing our exploding U.S. debt levels is going to become a U.S. citizen problem.
Now, there are a lot of people in the market who believe that with foreign buyers stepping back, that the marginal buyer is the leveraged hedge fund, people like Citadel, and the American public becoming increasingly active as buyers of treasuries. Would Citadel step in a bigger way to buy more treasuries into next year?
Well, let's just be very clear. The marginal buyer of treasuries is going to have to be American savers. No ifs, no ands, nor buts. And that's going to crowd out investment that American households would otherwise make in corporate bonds, equities, and other assets that contribute to the productive growth of our economy. That's where we're going to find the marginal buyer, and it's going to come at a cost in terms of our ability to create jobs and to enjoy a level of innovation and productivity that has defined so much of the life that we have lived in this country over the last century.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. Subscribe to our official YouTube channel here for weekly bullion market updates and exclusive service offerings like this one.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
The spot gold price rallied all week, closing just under $2,200 an ounce. In a minute, we'll look at where this rally might go in the short and medium term, at least throughout the year. The spot silver price also gained off the lead of gold, moving well over $24 an ounce to finish this week. The spot gold-silver ratio stayed relatively flat regardless of gold's record-heading headlines, closing the week at 89. In terms of this current gold rally versus the past, keeping its ongoing 200-day moving average into account, we're now about plus 10% above the current 200-day. On a historic full fiat currency era basis, this current rally is nothing out of the norm, even with the nominal numbers in new record territory. Even considering the last 5 years of 200-day moving averages in gold, we can see other 3 recent spikes in gold over its 200-day moving average that climbed higher than we currently are at the moment. Open interest on the COMEX has climbed with spot price moves of late, and given the influx of momentum traders, it was no surprise this week to see the COMEX raise margin requirements on both gold and silver futures contract trading. Currently, on a percentage basis, COMEX is still nowhere near its 6% gold margin or 10% silver margin requirement levels that past up and down volatility eras have breached. Turning to the increasingly more important gold market of China and its Shanghai Gold Exchange, perhaps a sign that China is looking to further crowd out Western markets in physical price discovery power, transaction fee costs on gold contracts throughout 2024 were announced lower this week. In just one glance at Shanghai versus COMEX gold market quote deliveries, often merely paper warrant transfers in the West, and it's obvious that since the 2008 global financial crisis, the Chinese market in terms of deliveries in physical form have basically dwarfed the Western COMEX system. And given the recent Q4 2023 and Q1 2024 increase in Indian silver demand, it was no surprise that London just announced having to cough up over 32 million ounces of silver in its vaulted holdings last month, February 2024. Now, as the world's largest mining nations like Mexico and Peru continue supplying less and less silver into a market with increasing physical demands, it's no surprise that rating unsecured ETFs like SLV has often been the stopgap measurement up to now. Now, if you believe SLV's numbers, since the start of 2021, about negative 270 million ounces have been pulled by APs, likely most of which headed east to India and perhaps growing Chinese industrial demand. Longtime COMEX traders like Peter Brandt were out this week, shot calling about where gold is potentially targeting to go on a technical basis in this move. And this week, another longtime gold trader put his current thoughts about where gold and later silver might be preparing to go and not all that long from now.
The clear winner this year, Nicole, is gold, and I think to the degree that gold is stretching towards that 2400 mark and new all-time nominal highs, silver closes the gap to its all-time highs of close to $50. So you could have a 100% move in silver in a 6 to 8 month period.
Of course, fellow silver bulls, let's start with spot plus 26 an ounce and then finally clear the long-term $30 an ounce TAMP level before we get too far ahead of ourselves. Finally, turning to the ongoing stock market bubble, which increasingly looks reckless in terms of AI hype, tech concentration, in both overall market cap and earnings shares overall, the CME Group published this simple long-term S&P divided by gold chart this past week, giving readers an overall sense of the historic severities between eras when U.S. stocks were expensive and or cheap relative to ongoing gold values at the time. Now, this is that same data, the S&P 500 divided by gold over an even longer basis, with the green percentage move from 1974 to 1980 gold peaks juxtaposed on where 2011 spiked low, and ultimately where we're likely going all the way out perhaps into the 2030s. Now, if gold simply repeats its outperformance from back then over the general U.S. stock market, we're looking at gold eventually buying more than 4 to 11 times the S&P 500's future value from where it is today. Now, given all these building bull market factors for bullion and more, I'm going to keep betting on bullion in a prudent physical position of my liquid net worth, and I'm confident many of you out there will too. That will be all for our weekly SD Bullion Market update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.